Hey everybody, welcome to the morning market briefing Wednesday. It's Wednesday. Off on my days, June 1st, 2022, 5 months down, 7 to go. Looking at futures right now, we've got Dow futures up close to 0.5%, S&P futures up about a quarter, NASDAQ futures up a quarter. Strong day for the Dow, potentially in the works. Ben, let's jump in and talk a little bit about earnings that we have trickling in, specifically from SalesForce. SalesForce up about 9% right now. Do you think that's justified?
That's really what's driving the Dow today. So, of course, Salesforce was added to the Dow last year, maybe it was the year before, actually, in the fall, and as an effort for the Dow to actually get more tech exposure into the index. At the time, right now you have very low buy side expectations, which means investors actually have fairly low expectations. Sell side expectations continue to be relatively elevated. And so you have this disparity where you can get comments like these out of Barclays, and I quote, "Inline results are better than expected," which kind of defies logic. But essentially what he's saying is that basically Salesforce came in line with what all the Wall Street analysts thought. But in terms of investors, investors have been really on the sidelines on a lot of companies, Salesforce included. Essentially what happened with Salesforce is they got really hit on foreign exchange. The Japanese currency really faded big time in the first quarter. That's the primary driver of their revenue downgrade for the year, but their margin is coming in better than expected. And as a result, they actually are up significantly this morning. For Salesforce specifically, I think it's worth noting that companies that sell to other companies, especially not on the advertising side, but companies that are actually selling to other on a B2B platform, not on ads, are actually holding up significantly better. And that's not just in tech, it's elsewhere as well. But if we look at the revenue growth numbers for a number of these companies, Facebook's expected to grow about 7% this year. That's a big deceleration from 37% last year. Amazon's expected to grow 12%, big deceleration from 22% last year. Salesforce, even with the currency effects, still expected to grow around 20 to 21%, only marginally down from 24% last year. So a lot more consistency in those B2B companies. And I think that that's continuing to be the case. Now, whether that continues to be the case, if revenue begins to slow and we go into a profit recession and companies begin to cut costs and they try to find ways to slim down, that would be the next step. But for now, B2B companies are actually holding up significantly better than B2C.
I'll say this, I don't love Salesforce just as a company. I actually think, however, that they're positioned relatively well. I mean, you think of organizations that use Salesforce, it becomes so ingrained in your day-to-day operation that if you're cutting costs, frankly, it's probably easier to cut humans than it is to actually drop Salesforce. I mean, if you think a number of larger investment advisors that I know use this, and so maybe they're running 40, 50 employees on this platform. They've got thousands and thousands of clients. To get rid of Salesforce, they suddenly lose a really vital tool for tracking relationships, tracking meetings, tracking investment policy statements, communication, all of that. It's probably relatively secure before they start dropping that thing.
Yeah, I would liken it to, it's a lifestyle product for a company. It's like having a company shift offices. It's like, as a consumer, moving a home. Once you have the house, once that infrastructure is in place, you don't really want to be chopping and changing that. It's a huge headache and your employees won't really like it.
Yeah. So I think they may actually weather the storm relatively well. Again, I don't love the company. Don't love the valuation. We actually had Salesforce here for a hot minute. It's terrible. I hated it. Have you used it, Tom?
I've never used it, no. But I know it's super popular. The people who really get into it, I mean, I've got a buddy whose whole job is he's a Salesforce consultant, and he basically goes into companies and teaches people how to use it, because I've heard that it's very clunky. Crazy. Like, unless you really know how to use it, then it can be pretty opaque.
Yeah, you almost have to know how to code and know what you're doing. When we got it was probably 8 or 10 years ago. we did not need it to begin with. There's somebody used to work here that kind of made the call, and the uptake on it was non-existent because we didn't know what we were doing. It was really tough. Russia has found a workaround on oil. I don't think this story, I don't know, it's not necessarily surprising to me, but it's quite flagrant. They're essentially refining oil in India and then exporting those refined products, whether it's gas, diesel, chemicals, whatever, to the US and to the European Union. They're basically passing this stuff off from one ship to another off the coast of West Africa and in the Black Sea. It just kind of continues to show that the economic sanctions and the attempts at turning this thing around through force of the economy may not necessarily be a route that works. I don't know if you guys have anything to add.
I think it's more of a taking the moral high ground at this point, and it's costing the West money. And I think that's just the cost benefit that we've collectively, our leaders have made the decision that we're not going to finance directly this war. And you can disagree with that, you can agree with that, but I do think that there's certainly a moral imperative more than an economic imperative. And I think that's the decision that's been made.
Yeah, but it's just like everything else we talked about. It's the law of unintended consequences. They're going to find a workaround anytime you put sanctions in place, whether it be, laws at the local level or sanctions at the international level. Someone's going to find a workaround. And I think this is just a natural progression of that.
Yeah, I agree with you to an extent, Ben, where it's the moral high ground, but kind of to Tom's point, the lack of foresight to realize they're going to figure out a way to move oil. I don't know. I'd like to think everyone knew that was happening.
Yeah. Yeah.
Janet Yellen says that she was wrong about the path inflation would take. Tom, not all that often we get to hear people come out and say they were wrong. Where was she wrong?
I think the first comment I like to make is, you think? We talked about this, ad nauseum when she was talking about inflation, being temporary, not going to be a big deal. They're going to find a workaround on it. And it's not going to be an issue. Well, she basically came out and said, quote, "I was wrong about the path inflation would take. There have been unanticipated and large shocks to the economy that have boosted energy and food prices and supply bottlenecks that have affected our economy badly at the time. I didn't fully understand." The thing is, most of these things that are affecting the supply side and energy prices are 8-9 months, 8 year old. All these things have been in place. You could argue that Ukraine has thrown a wrench in things with the Shanghai lockdowns, but we were having lockdowns, just as frequently a year ago as we are now, if not more so. None of these things are outside of the realm of things that already existed and were already driving inflation as early as, this time last year. So to be the Treasury Secretary, to be, a tenured Fed chair, and to say, well, I didn't understand how inflation was going to work, is a pretty bad look. And I think everyone at the time was saying, what are you talking about? This is getting sticky. We need to make moves now to change it. We need to raise rates now to change it. And to say that, I didn't understand at the time, we understood it at the time.
We were making jokes about what does transient mean. Okay, so it's not here to stay, but does that mean it's here for a year, 2 years, 10 years?
Yeah, what's the time period?
Yeah.
And, the longer they let it go on, the more sticky it got. And I think that, it feeds into that. And we were listening to her commentary this morning. Becky Quick was kind of pushing her on the op-ed piece yesterday. Came out and said that, if you read it, it literally puts the jobs market ahead of inflation in terms of priorities, which has never been the case for the Fed. How did that come about? How come it was written like that? And she didn't comment on that. She was asked about, is the Fed doing enough? Is Jay Powell, has he got the chutzpah to get this done? And she basically was like, I'm not going to comment on that, despite the fact that she was, the Fed chair right before him and probably has about as much leeway to comment as anyone. I think it's soft. I think the wording of this is, kind of down the party line, unexpected shocks to the economy, basically blaming it on Ukraine and not blaming it on the fact that everything was already in place a year ago. I think it's soft. I think it looks bad. I think it's a bad look for her. I think it's a bad look for the administration. You just can't come out and say, I didn't fully understand what was happening, when it was pretty clear what was happening.
I think the biggest problem that I think a lot of people are going to have with these comments is it not even saying that she was wrong. I think it's just because a lot of economists thought that way too at the time. But I think the lack of skin in the game, the lack of just the ability to come out and say I was wrong, and then continue to keep her job and continue to go on speaking tours and doing all this, it just rubs people the wrong way. And, you lose confidence with people, especially in a business. I mean, the Financial Media Collective, dissects every single comment, every single person speaking on finance or monetary policy, and it's dissected extremely, extremely carefully. And so the lack of precision with these comments is kind of just throwing the flip of the bird to the, yeah.
It's just sloppy. I mean, they're basically two people who run monetary policy, right? I mean, it's Jay Powell and it's Janet Yellen, and she's basically out there being like, "My bad, I didn't really figure this thing out."
And not even that, not even a full "my bad." It's kind of the apology where, like, I'm sorry if you were offended. I didn't realize you would be.
Yeah,
I'm sorry that there were things I did not anticipate. The reality is, if she'd come out and said, "I'm sorry, all the warning signs were there and I didn't listen to them," honestly, it'd be like, okay, well.
Yeah,
I'm not more confident in you, but there's at least some integrity behind that statement.
right. As opposed to, I didn't understand it. Plus, there was this other stuff that happened that wasn't my fault.
Yeah, it's kind of a wild thing. We do have some economic data coming in today at 10 a.m. We get the jobs opening. That's expected to remain pretty high, over 11 million. This is a delayed number. It's representing where we were in April. But we do have ISM manufacturing, maybe a little bit more nuanced and a little bit more to keep an eye on. We'll certainly run through it tomorrow morning in the call. But we're expecting a little bit of a decline to a reading of 54.5, down from 55.4. Ben, what are kind of the more nuanced intricacies of this report you're really looking at?
Yeah. So the big one tomorrow, we get the ADP employment number. And then on Friday, we get the big jobs number. So ISM manufacturing has an employment constituent within that. So I'm going to be really paying attention to that. I'm also paying attention to the commentary, because the commentary is really good on some of these reports. But then also prices are expected to decelerate to 80.5. So still very elevated, but down from 84.6 in the prior month. That may happen with aluminum, but it's going to be a little bit offset by oil, especially recently. So I'm not sure where those prices are going to come in. That'll be another one that I'm watching. And finally, new orders. New orders are a really good sense of where is the economy going, not just where the economy is. And that has continued to be weak over the last period of months. So want to see a little bit of stability there. Not hoping for it, though.
Tom, we should be hearing and seeing lots of headlines about quantitative tightening starting June 1st. The Fed has talked about this coming. It really in earnest is probably not going to really kick off till June 15th when we have some treasuries run off. But explain to everybody on the call kind of what this means, what the intended consequence is, and what you think the impact on Fed policy may be.
Yeah. So if you think of quantitative easing as printing money, which is essentially what it is, they're basically creating dollars out of thin air. And the way they do that is by buying treasuries, flooding the market with money, buying mortgage backs, and essentially bringing rates down. What we're seeing now is they're taking dollars off the table and essentially burning them. So they're going to be fewer dollars floating around the system as a function of the Fed running off its balance sheet and taking dollars out of the system. And so what they're going to do is they're going to start selling and letting run off $47.5 billion of their balance sheet starting today, primarily with mortgage backs today, and then treasuries starting on the 15th. So $30 billion in treasuries, $17.5 billion in mortgage backs. And then 3 months from now, they're going to step that up to double, with the cap being $95 billion, with $60 billion being treasuries and $35 billion being mortgage backs. And so what that's basically going to do is take, if you think of the yield curve as having an elephant sitting on a phone wire, he's basically going to be slowly getting up over the next few months and putting less and less pressure. It's an unnatural large buyer in the market. And so liquidity is probably going to become at a premium, particularly in treasuries and mortgage backs. I still think relative value wise, treasuries present good value for foreign investors, which will probably offset quite a bit of that buying. Mortgage backs, not so much, though. We've seen pretty much a free fall in mortgage backs. The rates have gone all the way up to 5.5%. They ticked down just a little bit, down about 5.35 on your average mortgage, 30-year fixed. but that's still exceptionally high. And now we're going to start really putting the pressure. They're going to be actively selling and running off these mortgage backs at a very large rate. I mean, if you think of, 17 and a half or $35 billion in terms of the number of homes that's going to reflect, I'd call it 300,000 a pop. I mean, that's a lot of mortgages that are going to be floating around in the system that were not previously there. And so that's going to put a lot of upward pressure on mortgage rates at a time where that's probably going to be a major driver in slowing the economy. And we've already seen, the number of houses trading hands really, really slow down, the number of mortgage applications really, really slowing down, and the cost of borrowing has gone up so much, in addition to the fact that the home prices have gone up quite a bit as well. And so it's really this perfect storm for a bad market in mortgages and slowing the housing market. So that's something we really need to be cognizant of. We need to be careful over the next couple of weeks with, what we're buying. Should we see liquidity really kind of fall out of the market? Bid-ask spreads on bonds are going to widen significantly if this really has a major impact. But it's the right thing to do. I think it's an additional step that they can do in addition to hiking rates that could have a beneficial effect on demand. How much is that going to affect it? We really don't know. We haven't seen much in the way of quantitative tightening. I mean, as long as I've been in the business, and we've basically been in a quantitative easing cycle for, call it 75% of the time that I've been trading bonds. So this should be a very interesting exercise in how does this work? What does it look like? How does the market react in terms of liquidity on the bond side? So a lot of moving pieces, definitely something to keep an eye on, but my expectation is that we should see a slow rise in interest rates, both on the treasury side and on the mortgage backed side. Pretty immediately. We're still lower than we were. I think the bond market was oversold. I think that, it's possible we could retrace back up to where we were given this move, but, it kind of remains to be seen. There are a lot of moving parts, and there's a lot of, foreign buyers moving in as well. So, we'll see how the market reacts. It's really kind of unknown territory.
So the context of this is, so we're talking 40 to 95 billion over the next few months on a monthly basis. And importantly, this is just running off right now. No, we're not selling right now, but the people have been talking about maybe we'll have to sell come December or January, simply because those mortgage-backed securities aren't going to be running off. I mean, I'm very curious. So we have a $9 trillion balance sheet right now, need to get to 5 trillion probably over the next 2-3 years. With these runoffs, obviously $90 billion isn't going to get it done if you do the math. The question is, can we even run off that amount of money? Because we're not going to have many people refinancing. We're not going to have pretty much anyone refinancing right now. So all of that's going to happen with transactions. Mortgage applications are at pretty much the lowest level since 2018 right now. So we're going to have supply that's very limited of new mortgages. We're going to probably have refinancing that's relatively slow, in which case we actually might see, even with this runoff commencing, we might not see a ton of additional supply actually coming to the market if you look at it net.
Yeah.
And we've already seen some people like Annalie taking the other side of the trade, starting to buy because the spreads are so wide right now with mortgage-backed securities. So I'm curious to see how they trade. I would agree with you. You don't want to fight the Fed.
Yeah.
But there, at some point, there will be a time where you want to take the other side of that trade.
100%.
And we just have to continue to be mindful of that.
Yeah, I think the pace is interesting. I mean, Ben, as you talk, like going from 9 trillion to call it 5 trillion, at the current pace, I mean, we're nowhere close to that even when we hit 95 billion runoff. So they're going to have to, I think they're going to have to be buying. We're looking at 1.1 trillion a year and change. It's going to be interesting to see. I mean, we do have another Fed meeting coming up mid-June. That'll reflect the jobs number that we're going to get this Friday, as well as the CPI number that we expect to get next Friday. So there'll be a lot to process. I think of those two, CPI should be the most important number. I won't be surprised if jobs actually is, just given the tone and the rhetoric and the safe-facedness of the Fed. So we'll keep an eye on that. We'll be back tomorrow morning at 8:30. Hope you guys have a great day. Talk to you Thursday.